Hello guys and welcome to another deep value video. Today taking a in-depth look at DLTR Incorporated, an American multi-price point chain of discount variety stores. It is a pretty well-known company. I think you've heard of it, and let's get into it. First, we start with the valuation. They have a great free cash flow yield of 9.87%, a price to earnings of 20. But if we go over to the business metrics, we see that they're not doing as well. Their return on tangible assets is negative, their ROE is negative. Their current ratio is pretty good since it's 1.06, so they have good short-term liquidity. And their ROIC is average, I would say, at sitting at 9.17%. Now, let's go to Grant's valuation using an estimated earnings per share of 5.21 for 2025, a growth rate of 6.5%, and the current yield, on AAA corporate bonds of 5.54%. We get an intrinsic value of $55.86. Next, going to the discounted cash flow model, we get an average growth rate of I put in a growth rate of 6.5% with a perpetual of 2% and a discount rate of 8%, and we get an intrinsic value of $131.2. Next, going on to historical multiples, we can see that their average multiples in the past has been 16 to 20. Now, of course, they have a negative multiple due to their earnings in 2024, but they are positive now again, so this is not a problem. This is just temporary. The multiples variation, I've compared them to Walmart, Target, and Dollar General, which have an average P of 25, and if Dollar Tree manages to reach that price to earnings, then they have about a 25 to 30% upside from the current prices. The dividend discount model will not be used in this case, and the output is the average of grams and DCF, which gives us an intrinsic value of $93, which is very close to the current price. Applying, of course, a mandatory margin of safety of 15%, we get an acceptable buy price of $79.5, suggesting that the stock is a sell at the current prices. Now, personally, I believe that this is a business which has been in a small drought and has managed to recover. We can see from the stock price, which has climbed up over the past half year or so. So they have managed to slightly turn the ship around. This is great, shows capable management. But of course, we cannot all be too sure that they will achieve such high growth rates in the future because retailers discount stores reaching a 6.5% growth rate over the long term is definitely something which can be discussed. I don't think they'll reach a 6.5 growth rate for more than a decade, but that's the scope of this discounted cash flow. It's only 9 years, so this is not really that important. Now, personally, what I find very interesting at Dollar Tree is that I've seen very bad consumer and customer reviews. Now, this is not really a big problem since they have the advantage of being so cheap, but maybe in the future it will bite them in their back. Now, if you believe they're a buy, of course, buy it. This is not really that overvalued, so it might be a buy for some people. I mean, if you just go by the DCF alone, they're a buy. If you go by grams, they're a sell. So it depends on how you calculate your own valuations. So this is why you must do your own valuations. This is why you must do your own due diligence, because what I say here, what I do here, this is purely my perspective. This is purely my opinion, and I'm not a financial advisor. This has been it for today. Before ending the video, I'd like to talk a bit about our affiliate, Ticker Data. Ticker Data is the tool that I used. Ticker Data, I'll just show you what it does. You put in a ticker symbol in this Excel spreadsheet, you put in the recent fiscal year, and voila, all of the data appears in real time. So this is great. You can change, you can play with the numbers. So for example, let's say 11.83 with a, I don't know, 10% growth rate, I don't know how much yield. So we can play around with all of this entire spreadsheet, and this is also very cheap. And for you self investors out there, I think you'll love it. Also, do not forget to check out my investing blog where I feature in-depth analysis on a diverse set of investing topics, and I hope to see you in the next video. Bye.